Hey, I'm Zach McDonald, your real estate agent with Real Property Associates, and we are continuing our series, Questions That Every Home Buyer Should Ask. I'm here with Dan Keller, branch manager, mortgage advisor with Guild Mortgage, one of the best mortgage lenders in the Seattle area. And Dan, can you answer this question for us? What is an adjustable rate mortgage? And then part two of that question, is it ever a good idea to get an adjustable rate mortgage?
Yeah, so let's talk ARMs. I think I did actually my most viewed YouTube video is a video that I did back in 2012 talking about adjustable rate mortgages, because adjustable rate mortgages do get a bad rap because they were a type of an adjustable rate mortgage was responsible for the bad mortgages that were sold that caused the last housing collapse in 06 and 07. A lot has changed with them as we migrated into the new world of mortgages. And so I'm not gonna go into depth there, but it is important to understand that the adjustable rate mortgages that we're talking about today are much different from the ones in the past, okay? But essentially an adjustable rate mortgage, or otherwise found online, an ARM, A-R-M, is a mortgage that is fixed for a short term. For an example, let's say we're talking about a 5-1 adjustable rate mortgage or a 5-1 ARM. You would get a lower than market, if you will, lower than 30-year fixed rate for 5 years. And it's not much lower. The margins aren't great. So let's say, and this is not a rate quote, but let's say that a 30-year fixed rate mortgage today is 5%. You can get an adjustable rate mortgage, a 5-1 adjustable rate mortgage, let's say for 4.5%. So about a half a percentage point delta. The big thing about an adjustable rate mortgage is what happens after those 5 years. So are adjustable rate mortgages bad? No. I think if it ties into your short-term and your long-term financial strategy, if you have someone like myself explaining the ins and outs of that adjustable rate mortgage, and then you've talked with a financial professional like a financial planner or a financial advisor, and the savings that you get by choosing an adjustable rate mortgage over a 30-year fixed, if something's done with that savings, whether it's reinvesting in the stock market or prepaying your mortgage, which I don't believe in prepaying your mortgage. So take the savings, if it's $500 a month in savings, and making sure you're maxing out your 401k or your stock or contributing it to investing in the stock market. But as long as there's a strategy around the why behind why am I choosing an adjustable rate mortgage? Well, because the rate's lower. Bad strategy, okay? So are they bad? No. Full disclosure, I personally purchased a house about a year and a half ago. And my wife and I chose to use a 7-1 adjustable rate mortgage. And the reason why, well, let me ask you this. What do you think, as a real estate professional, and based on the data that you study and that you know, how long is the typical homeowner in a house?
It's in that 7 to 10 year range.
7 to 10 year range. So let's talk about our situation. At the time I was 41. My daughter was 11, my son was 9, just entering middle school. They've got about 6, 7 years, and my daughter is going to be out of high school. And then I've got another year or two in my son. We won't need this house, this big house. And so our goal, and what I try to get all my clients to do, is look at your mortgage, look at this real estate transaction as a financial decision as it factors into your short-term and your long-term goals. And if an adjustable rate mortgage makes sense, so be it. I will say this, typically you need to put 20% down or greater to get an adjustable rate mortgage. So it's not for the first-time home buyers. It's not for people just starting out.
You can't put down 1% and get 2% credit and get an adjustable rate mortgage.
They want to see, and there's certain qualifying guidelines too that'll come into play.
Okay. What's the risk though to an adjustable rate mortgage for those that are maybe thinking, oh, this might be good for me? What's the risk if it doesn't go quite according to that plan?
The biggest risk is the first word in the sentence, adjustable. It's adjusting. It's going to adjust after the fixed rate period. So after 7 years, it's going to adjust either up or down depending on the index and depending on the markets and where they're at, what it's tied to. And so I tell my clients, I would imagine that in 7 years, there's no proof and there's no guarantee, but I would imagine that an adjustable rate mortgage in 7 years will adjust upward. But then there are adjust caps. There's cap rates, meaning an adjustable rate mortgage can only adjust so much in a certain period of time. So it's not like it's going to go from, I think our adjustable rate mortgage is at 3.875 right now. It's not going to go to 7% overnight in 7 years. All right, it'll adjust in increments. Safe increments. But
Yeah.
that's the biggest risk, is that, hey, in 7 years, I see myself staying in this house for another 3. Well, now that mortgage is now variable. That's the risk.
Yeah, cool. Thanks, Dan.
Yeah.
So if you guys are watching this and you're finding this content valuable, you're getting some good insights from Dan, you can actually look up his YouTube channel under the name Dan Keller. And of course, if you're liking the content on this channel, please consider subscribing.